Fish your moment. Warrior, woke up with purpose, grinding with grace. Built from the pain, now we taking our place. Money on mission, legacy in sight. Faith in the fire, we still shine bright. Victory Life. Victory Life. Solutions, moving in power, stacking up wins, every minute, every hour, molding our walk, unstoppable truth, rising up strong, now we speak to the youth, yeah. No fear, no doubt, we breaking them chains, talking freedom, wealth, love, not just change. This the blueprint to break through the vibe. Victory Life Solutions, we alive. Yeah, Victory Life Solutions, we alive.
Welcome, everyone, to a presentation on your finances and understanding what the big picture really is all about. I work with United Financial Freedom, and I am here to talk to you about debt and how you can eliminate your debt. That includes your mortgage, your student loans, any home loans that you might have, any personal loans, and any credit cards that you might have as well. That's right, everyone. Oh, did I mention your vehicle? That's right. If you have a vehicle that's financed, that's considered debt. A lot of times people, when you say to them, do you have any debt? They say, oh, no, I just have a mortgage. Well, guess what? Newsflash, that's debt. Okay. So today we're going to talk about what debt is and how you're going to be able to learn to eliminate that debt. Wouldn't we all love to just have the life that we want to live, not the life that we dream about? I have that life. I want you to have that life as well. Okay. All right. So the more that you know about your financial options, I want to tell you that that's the greater chance that you will ever have to save hundreds and thousands of dollars. And who wants to keep that money? Do you want to give it to the bank or do you want to put it in your own pocket? We're going to talk about what that looks like. Now, perhaps this video you've already answered your own question. If that's the case, all I ask that you do is please share this video with someone else. They may not be able to do what you've already done if you've eliminated your debt, but they still need an opportunity to learn how it's done. All right? Now, when we think about debt, a lot of times we think about things that are, oh, I can't pay my bills, or, oh my goodness, I have bad credit. Well, let me tell you what debt is. Debt is anything that you owe, all right? All of those things that I just mentioned, that's what debt is. Now, the story for United Financial Freedom, they started in 1997 in the mortgage industry. So any of you who are in banking or financing, you understand how the mortgage industry works. For those of you who are not, let me just give you a little hint. The mortgage industry is designed that when you take out a mortgage on your property, whether it's a business mortgage or whether it's a personal mortgage, doesn't matter, it's designed to accrue an interest over a period of time. In fact, what they do when you sign and complete the mortgage application, they'll show you, it's called the truth in lending, exactly how much you're really going to pay for that house or that building or that business, okay? Now, when you look at it, you're going to see something that's called the interest rate. So when I talk to people on the street and I say, hey, do you know of anyone that has debt and would like to eliminate their debt? They'll say, no, I don't know anyone with debt. Well, newsflash, just about every person is in debt in some capacity or not, unless, again, like I said before, they've used this program. So when this program first started in 1997, it was one of Utah's fastest growing companies for 3 solid years. Now, for anybody that's been in business for any length of time, you and I all know that 3 to 5 years in business successfully, Well, man, that's a testimony, okay? So for them to have been successful and the fastest growing for 3 years, that tells you a lot about the integrity of the company, tells you a lot about their ability to keep their word about what exactly is happening. Well, we're going to find out what that is. So basically, what the company did is it realized a significant problem with debt. So in 2004, that was when the first version of this program was launched. So when you think about 2004 to 2025, that's about what, 21 years that we've been in business? I would say that's longevity. What do you say? Now, when you look at this, you see this lady, she's got her house, right? And what do a lot of people use their house for? Unfortunately, they use it like it's an ATM machine. And how does that happen? Because they go out and they get these loans taken out and they use their home as the secure interest that if they default on that loan, then guess what? Unfortunately, someone could come and take that house because the house was used as collateral. With the program that we will teach you about today, you don't have to worry about doing that and jeopardizing losing your home. That's why this is so important, okay? Now, what we use is called the Money Max program, okay? And the Money Max program is basically an account that allows you to set up with all of your debt and put everything in there. They want to know your interest rate. They want to know what payments you're paying monthly. They want to know the original amount of the debt, and they want to know what is the balance today. And there's some other questions. In fact, what I do is I provide a free debt analysis. Now, here's what you don't have to worry about when you sign up and schedule a meeting with me. You do not have to worry about giving me your social security number. It's safe. We don't manage your money. We don't even touch your money when we give you this free analysis. And this company that I'm representing, they don't do it either. So what is the risk? And what are you waiting for? When I tell you the goal and the prize ahead for you, I'm going to ask you that question. What are you waiting for to get started? Well, let's get back on track. With the Money Max account, what you'll be able to do is just put down the number of credit cards you have and just you could do a generic name. You can say credit card one, credit card two. You don't need to say Citibank if you don't want to. You don't have to say Wells Fargo if you don't want to, because we don't need that information. But what you want to do is be as accurate as possible, that you are telling the truth about what company it is in terms of just a list of the name. It could be generic, like I said, but more importantly, what is the balance? What is the original amount of the loan? What is the interest rate? And what is your payment? Okay. Now, 400 homeowners were tested to find out what type of way this program was really, really going to work. Okay. And so we found that the average client, when they used the Money Max account, they were 20% ahead of schedule. Now, when you test something and you find out that 20% of the people are ahead of schedule, that's telling you something is working right. So to date, what we've done is we've helped homeowners eliminate over 2 million. I'm sorry, did I say 2 million? No, you would expect me to say 2 million. But what I really want to tell you is that we respectfully, and the number keeps climbing daily, we have respectfully eliminated through this program 2,641,715,103 in total debt. And like I said, and counting. That's how we've helped people to eliminate their debt, and especially homeowners. Now, remember, you don't have to have a home to qualify for the program. You just have to have debt. How easy is that? So now, one of the things that I want to bring out about the company, because everybody, when you're considering how can something work for you, the first thing you want to know is, what is the integrity of that company? Or what is their award winning? Or What makes them so special, or what makes them stand out? Well, I'll tell you. With United Financial Freedom, here's what their national recognition has brought. Ernst& Young nominated them as Entrepreneur of the Year in 2008. They received an award in the Utah region. I would say that's pretty significant, wouldn't you? And not only that, the Financial Services Division has been featured in many, many publications, as you'll see there. There is Success Magazine, there's Investment Magazine, there's Home Buyers Magazine, and the list goes on and on. Now, there's some intensive due diligence that this company had to undergo. The financials were looked at, how long the company had been in business, what is the retention rate and value ahead for this business, what is the product viability, what is the impact on consumers, because when someone is being recognized by Ernst& Young as Entrepreneur of the Year, they don't take that lightly. And so United Financial was awarded that award back in 2008, and it's still going strong today. Now, here are some other individuals that have received that award as well, and you can see the emblems there or the logos there. Microsoft, everybody knows about Microsoft. They've received that Entrepreneurship Ernst & Young Award as well. eBay, Starbucks, and of course, Apple. Now, there are 8 banking principles that are very important for you to know about. Number 1 is closed-end loans. And we're going to talk a little bit about what that is. Number 2, mortgage amortization. So let me just say, mortgage amortization is, again, in that truth in lending statement that you get after you get a mortgage, or even before then, they have to disclose it. It tells you, based upon the number of years that that mortgage is going to be financing that house, from day 1 to day 30, if it's a 30-year mortgage, I'm sorry, year 30, what'll happen is how much interest you're paying and how much principal you're paying. Now, if anyone knows anything about mortgages, I'll tell you if you don't. At year 15 is when you start to see more money that you've been paying all that time every month start to go to the principal. And when it starts to go to the principal in year 15, if it's a 30-year mortgage, then the price of the home, meaning not the price, I'm sorry, the principal on the home starts to go down, meaning you're paying more of the house off. Now, did I tell you that starts in year 15, where the most of what you've been paying a month for 15 years now has all of a sudden, based on this mortgage or amortization, start to bring down the principal balance of that loan. Why do you think that is? Well, it's because the mortgage companies or the brokers or the banks have learned that a brick and mortar is going to outlast most other type of loans that are placed on goods and services. Okay, so what ends up happening is that they know that people are not going to just sell the house today or tomorrow. They're going to live in that house. Now, with a car, it's a little different. Now, there's an analogy that I like to use. And I'm not saying people are driving these cars every day, but those that do, you'll recognize what I'm talking about. So let's say you go out and you buy a Bentley for $250,000. You could pay that Bentley off in 5 years or less, 4 years. They're not going to finance you to purchase that car. And I'm only using it in parallel to a sizable mortgage of $250,000. But getting back to the car, they're not going to give you a $250,000 accrued or mortgage amortization type loan for 30 years because they know that car is not going to last for 30 years. But with a house, which is brick and mortar, it's going to last. So the banks have learned how to, and this goes back eons, not yesterday, but eons when the banking financial institutions started. They learned very quickly that yes, you could pay off that car loan sooner because we know that vehicle is not going to last as long. But why not let them start out with a mortgage that's going to stretch out 30 years? Something to think about, isn't it? I thought you'd like to know. So then there's what's called interest cancellation. Okay. And with interest cancellation, one of those principles is that it can instantly be canceled in terms of you don't have to pay the interest on a loan. But let me ask you a question. How often does that happen? And if there's anyone that's ever had that to happen, I want to say to you, we applaud you. Good job. Now, another principle is open-ended loans or line of credit. What that means is almost like a revolving account. So you have a line of credit, you could pay that line of credit down or off, and then guess what? You can still use it. And it's kind of like having a credit card, okay? So whether it's a HELOC, whether it is a credit card, basically you have that card, has a limit, you can use it, you can pay it off, you can do whatever you need to do with it, okay? Number 5 is offset accounts, okay? And with offset accounts, that's basically where you have accounts that kind of offset the whole amount of what's owed on that account, okay? Then there's float and leverage, there's interest accumulation, and there's strategic debt payoff. That's what we're going to talk about today is a strategic plan for paying off debt. Now, closed-end loans allows payments in, no withdrawals, requires at minimum a full scheduled payment driven by an amortization schedule. Any money applied does not affect interest charges until the following month. It calculates interest charges from the previous month end principal balance, and then it goes to the next part. Now, when we think about mortgage amortization, keep in mind this is going to be based on a $400,000 mortgage. It's 6% interest rate, and the payment on this mortgage is $2,398.20. And that's going to be amortized over 360-month terms or 30 years. Okay. Now, month one, the principal on that loan or that mortgage is $398.20. Now, the interest, I want you to watch this very carefully. The interest on this loan is $2,000, and that's just month one. Let me ask you this question. What could you do if you had that $2,000 in your pocket? Because remember, I told you it takes 15 years for all of a sudden that now you're going to be flipping how much is going toward the principal versus how much you're paying in interest. But in month one and on, it doesn't get there to a good 15 years, okay? So that's 83% interest. Now listen, so when people tell me my mortgage rate or the interest that I have is real good, 3.25, I don't care if it's 1.5. You're giving the bank that money. But if you look at this 83%, although at the top it says that you have a 6% interest rate on this $400,000 mortgage, truthfully, you're paying 83% in interest because $2,000 for interest is not the same as that $398.20 in principal. Doesn't this look a little unbalanced in this picture? Yes, of course it does. Because it means that you're paying more to the bank than you are paying off your house. But with this program, you're going to see we flip it for you. Now, in month two, oh my gosh, look at you. You paid, oh my goodness, look like a whole $2 extra on that principal for that house. So that mortgage balance went down two more extra dollars. Okay. I'm being a little silly there. But you can see in month two, the principal starts to, add a little more, right? $2 more on this one. Oh, did I add the 1 cent, a penny? So $2 and a penny. went more toward the principal this time in month 2, but that interest is still pretty hefty, okay? It's still $1,998.01. I think you might want to have that money in your pocket. Now, those are just the months, okay? So difference $1.99. Now, let's look at a year. A whole year has gone by. We saw the difference in 2 months, barely, $1.99. And then in year 1, are you that much more further ahead? No. You're still paying $420.66. That's all that's going to the principal. No wonder it takes you 30 years to pay off a mortgage if that's the trickle effect of how much you're paying literally for that loan. So all of that in that truth in lending list has all this information. But for this demonstration, it kind of gives you, I hope, an eye-awakening opportunity to see where your money is really going. And I can tell you where it's not going. It's not going in your pocket, which is what we help to do. We help to put the money that you've been spending and all this interest in your own pocket. And then we teach you how to build wealth. But we'll talk about that another time. So when you think about year 5, look at that. Almost $100 now is going towards your principal. And then in interest, you've already paid, believe it or not, $116,000. Oh my God, 116,000. Well, let me add the $109 to that. That's how much interest you've paid in 5 years. The equity that you have, instead of having more equity or more payoff toward that principal, you only have $27,782 in equity. But you paid on in 5 years on this mortgage at $2,398.20. You have paid $143,892 extra to the bank. Well, I'm sorry. For that amount, you could have went ahead and bought a whole nother house. If you had this program, you would know that's possible because you would know that you would have been saving that interest. That interest savings would have been going into your pocket or into a vehicle that would be making more money for you. But maybe this isn't for you because maybe you're not getting it. So just share the video. Okay. Just click the share button, share this video, and let someone else be able to get this. But for those of you, my Victorians, who are still with me, hang in there because we're going somewhere. Now, year 10. Now we skipped and we're just going up to year 10 now. From month 1, where we were paying $398.20 on the principal, in 10 years, we've only gotten up to $720.88. So it still seems like with $1,000, $677.32, seems like we're still behind in paying off this mortgage. And it's still year 10. So I know you're all saying, well, how is this possible that our program is able to, and I like to say, hijack the interest rate? You're going to find out shortly. But thinking about that year 10, the balance on the house is still $334,743. Now, year 1, it was $395,087. And you mean to tell me from year 1 to year 10, we basically have not really paid off too much except $65,256 is the equity in that house. Unbelievable. But we don't know what's happening until we know what's happening. Okay. So how much money have you paid in 10 years? $287,784. I don't know about you, but I'm not trying to just give my money away. Now, in year 21, now we're starting to make a little more in terms of adding a little more principal. It's almost $1,400 from year 10. That's insane. You mean to tell me in year 21, you're only now starting to pay $1,392.46 on the principal? 21 years. Think about that for a moment. And the balance on the house is only half on a 30-year mortgage. And like I said in the other video, now they're talking about the possibility of a 50-year mortgage. So how much you think you're going to be paying down on that mortgage? Well, I tell you how much you'll probably be paying in an interest, a whole lot more. And it's probably that 83% that you'd be paying in interest. That's the real interest rate, not that 6% that they tell you about. And this is simple math, not magic. Okay. And so in 21 years, you would have paid $604,346. Now, I want you to ask yourself, wasn't my mortgage loan originally $400,000? And that answer would be a resounding yes. So wait a minute, Cheryl, you mean to tell me I took out a loan for $400,000 and in year 21, I have paid $604,346, yet I still have only put $200,244 on the house, which is a little bit like half in 21 years. That's all the progress I've made. If I were talking to my Cheryl self, I'd say, yes, you're absolutely right. That's all the progress that you've made. So when you think about it, basically what's happened, that's the halfway mark. Now I said 15 years, depends on, where you are and what type of mortgage you have. But in this particular instance, the halfway mark is 21 years. Man, you mean to tell me the balance is still 190? That's half of what I originally borrowed. And the bank is getting all that money. And let's see what happens in year 30. Oh, wow, guess what? I've paid the mortgage off. It's now my home, free and clear, 30 years. Now, if you were 30, you're 60 now. Let's keep that in mind. If you were 50, you're 80 now. And how much did they say that interest rate really was? 6%? No, darling. That real interest rate is 116%. And by the time of 30 years, instead of paying the 400,000, and we know we have to pay interest, but you didn't know that you would have paid $863,354. This is insane. This is why you need a program that's going to teach you how to, one, bank like a bank, because you're going to think like a banker, okay? And number two, you're going to eliminate debt, okay? Now, this is not for people who have like really, really bad credit and, you don't have any discretionary income to pay down the debt. You need those, you don't need to have a stellar credit card, credit what do you call it, a credit score, but you do need to have some discretionary income. That's why it's so important for us to help you. And you won't know what that is and the kind of help you can get unless you do the free analysis that I offer. Now, let's go back to this $400,000 mortgage, okay, at a 4.5% amortization, okay? So you look at year one right here, interest total per year, $17,867.98. That's what you're paying if you have a $400,000 mortgage, okay? The total interest, we've got that right there, year to date, because it's just the first year. So that would be the same. And then per year, the total PMTs per year is $24,320.88. And the interest the first year, you really, instead of that 6% we talked about, you're really paying 73.47% interest. Yeah. Now, if you look, it's not really going to change much until you get to year 5. And even with that, you're starting to see just maybe a little bit of a change, okay? Because now it's only 68.25% that you're paying in interest by year 5, okay? Now, when you start to look at interest cancellation, very, very important. And we're still basing it on the same $400,000 mortgage, still looking at a 6% interest rate, still looking at 360-month term. In January, the payment, you can see how all of that is done in terms of January, the payment that we talked about, $2,398.20. The principal, like we talked about before, is $398.20. And then you can see the interest. We talked about that, $2,000. And the total interest, of course, is the same. And then the balance is $399,601.80. In February, not much has changed. And you can continue to see that not much has changed. Okay. Now, when you look at this, I want you to look in the center of the principal. Keep in mind the change is minimal. I mean, like barely anything is happening. You got $2, $4, $6, $8 extra on the principal. That's all that's accumulating. So the principal now in 6 months, you paid $2,021.06, but your payment that you've paid actually, that's just the principal, the $2,021.06. But total payment that you've paid in 6 months was $14,389.20. Ask yourself what you could have done with that money, because a lot of it is not going to the house. That's for sure. We see that right here. Okay. So if you were to start canceling out this interest, then you would see that basically the extra principal, $2,021.06. Okay. And the interest, well, guess what? $9,969.94. That's what you could have saved with this program. Okay. So would you invest 5 months of principal payments, $2,000 to save $10,000? That's what I'd like to ask you. I'm going to ask you one more time. Would you invest 5 months of principal payments at $2,000 to save $10,000? Now, let's look at sending an extra principal, because a lot of times people say, oh, I just put a little bit extra on there. I can pay my mortgage off. I just do a little extra. Well, I want you to think about what's coming up next. Right now, we're in November. We're going to give thanks because we're going to have Thanksgiving. And then we're going to have a little special time. And it's going to be New Year's Eve and January 1st. And everybody does this just about. They make a wish, or they make a declaration, or they make a claim. And that year or this year coming, there are going to be people that are going to say, I'm going to pay off all my debt. And they're also going to say, I'm going to lose weight. Those are the two most popular things that every year people make those declarations. They're going to lose weight. They're going to get out of debt. But the truth is, if we all be honest, those who are still in debt, they would tell you maybe they lost weight, but they sure didn't get out of debt. Because unless you know how to be your own financial GPS, I'll tell you, yes, you can add a little more payment, but it really isn't going to help you really pay off that debt like this program will. So an open-ended loan or lines of credit, basically what it does is it allows payments in and withdrawals out. It requires at minimum an interest-only payment driven by a draw period or repayment period. Any money applied affects interest charges on a daily basis, and it calculates interest charges on an average daily balance. Okay. Now, one thing about banks is that they understand and use this one concept that I want you to think about: no stagnant money. Banks are depositories, okay? They receive your money, but one of the things that they don't do is they don't hold on to it. You think they do, but they really don't. Okay. They can't. They can't let that money just sit there, because the money is not going to do any good just sitting there. It has to be let out. Okay. So smart investors do what banks do. They don't hold on to their money either. And you have to learn how to move the right amount of money at the right time from one account to another account. And we teach you that. Okay. And another thing that banking, like a bank does, or what banks do, they let it sit for the right length of time. Now, there is a period where it sits, just not as long as you would think. Okay. And it's sitting for a real purpose. One of the other things that banks do, they have what's called a sweep account. And when they offer a sweep account to you, basically every day at the close of business, the bank sweeps the checking and savings accounts of all their clients into a high interest bearing account. And why do you think they do that? Because they're making money off of you. Now, even when you say, well, I get 5% interest on my money in the bank, you would be shocked to know how much money they make off of you. Trust me. Look at the key word here. High interest bearing account is what they do when they sweep their accounts. Okay. And they do this every day at the close of business. That's because they know how to bank. And that's why we're going to teach you how to bank like a bank. Okay. All right. So banks also, they use our money to earn interest for not you. Because remember, they only pay you 5%. But most bank accounts now don't even have maybe 0.1 or maybe 1% interest, but nothing like what they're making off of you with your money. Okay. So, but they use your money to earn interest for themselves while they sleep, relending our deposits. While we sleep, they're making money. Okay. We want you to do this. They also know how money works 24 hours a day, 7 days a week, 365 days a year. I'd ask you the question, do you know how it works? Well, perhaps, but not really, but you'll learn. Offset accounts, basically, interest offset account is the open-ended account. And what that does is allows you to strategically leverage your money, either earn or cancel interest. How many people would love to have that? I'd say everybody should raise their hand. Okay. Now, the open ended account, these are your HELOC, for example. That's your home equity line of credit, and it allows you to cancel interest. Checking your savings accounts basically have an initial starter offset account to do what? Cancel interest. And then there's high cash value permanent life insurance that allows you to earn and cancel interest. So it's kind of like putting everything together. Okay. Now, canceling interest with an offset account looks like this. So you have the mortgage, which is closed ended loan. Okay. Meaning it's just the loan that you have. It's not going to change pretty much unless it's an adjustable rate mortgage and all of that. But typically it's just a closed end loan. The HELOC is an open-ended account, and meaning that you can borrow from it, you can, and do what you need to do with it. It has a LOC, has savings, has permanent life insurance, and all that. All those things are called open-ended accounts, offset accounts. Okay. The HELOC, the LOC, that's the line of credit, savings accounts, permanent life insurance. Now, when you look at the HELOC, an open-ended line of credit offset account might have a 10% rate on it. Now, remember, I've already told you these interest rates that you think you're getting really aren't that. Okay. So we're going to look at $25,000 and we're going to look at borrowing money from your offset account to pay down your first mortgage. Okay. Now, you got to know how to really do this, and we teach you that. You can transfer $5,000. Remember, you've got a HELOC, which is a $25,000 amount that you can, borrow and do what you want to do with it. And so let's say you transferred $5,000. Now, when you do that, you're going to put that onto the mortgage. Okay. We teach you how that works. So now instead of owing $400,000, you've just took the $5,000 put on that mortgage. Now you owe $395,000. Okay. So future mortgage cancellation interest is $24,136.34. So you're kind of beating the odds because you're paying more down to get out of that mortgage sooner. So you've just eliminated 12 payments when you do this. Okay. They're just putting the $5,000 down. So then Number 6 basically is float and leverage. Okay, you can see there's a Visa card. And when you pay your Visa bill in full at the end of the month, you're doing what? You're floating the balance. Okay. And you're also leveraging the lender's money interest free for 24 to 45 days. Okay. And that depends on the credit card provider that you have. So now let's go back to this $400,000 mortgage. We're going to float and leverage this account. And you've got $5,000 paycheck, $4,000 expenses, which means you've got like $1,000 left. Okay. With the HELOC, you took the $5,000 out. That's why you've got the $395,000 mortgage. And then you've got the credit cards, Sky Miles, rewards, cash back. Okay. Those are the kind of cards you really want to think about when you do have them. But we're going to teach you how to eliminate those debt of those cards. So now this $5,000 goes into the HELOC, and now your payment is $0. Okay. And then when you think about with the credit card, your expenses went up to $4,000. Now, what you're going to now do is take the HELOC and you're going to pay off that $4,000. Now, all those credit cards are zero. Now, that's the way that you really can float and leverage a HELOC for your mortgage. Now, if you look at all these different interest rates here, they're varying. You've got 7% for lines of credit. You've got 6.125% for furniture, 6.125% for college debt, 6.75% for an auto loan, 6% for a trailer loan, and 6.5% for a mortgage. But the way that these are structured, meaning these interest rates, the accrual of that interest is calculated totally different for each one of those types of accounts. For example, for the auto loan, remember, you could pay that car off in 4 to 5 years. You're going to take 30 years to pay off the mortgage. For lines of credit, 10 to 15 years, depending on the way it's structured. For college debt, well, I mean, when most of the America is in debt with student loans, imagine how long it's going to take you to pay that off. It's definitely not going to be as short as you think. And then, of course, the auto loan, we said 4 to 5, and trailer loan, typically, like they could be like 5 to 7 years to pay off. Now, my question to you would become, which one would you pay off first? Would it be the line of credit? Would it be the mortgage loan? Would it be the college debt? Which one would you pay off first? So no one has the systems to do it themselves. And that's what I'm really trying to drive at. So regardless of your resolutions for the new year, that you're going to pay off your debt and you're going to lose weight, you may lose weight, but you're definitely not going to lose those credit cards unless you do something differently. But no one has time to do this on their own. You need help. And one of the things that we all have to admit when we need help is that I need help. You see this man, he's scratching his head like he looks like he needs help. Do you need help? Is this something that you really want to change in your life? So instead of giving from a $2,300 or $2,400 mortgage payment a month, giving $2,000 of that away, wouldn't you like to put that in your pocket? Well, it's too complicated to do manually. So that's why we have a program that can assist you so you don't have to worry about that. And it's also too complex to navigate. Did I say navigate? Well, Cheryl, let's just tell everybody about this is a financial GPS system, everybody. That's what this really is. And let me give you the best way to understand what that means. So let's just say your house is 3 miles up the road. You know there's a straight shot to get to your house. But you decide, for whatever reason, to put it in your GPS. Let's say you're just testing out to see if it works. You put your address in the GPS, and it tells you turn right at the stop sign, turn left at this traffic light, and turn left again at the other traffic light. And if you're looking at it on a preview like I do sometimes, you go, huh? I'm doing like the guy. Huh? What are you talking about? My house is right up the road. I know if I just go straight down Home Avenue, I'm going to get to my house. But what we're not smart enough to know is that just like a car GPS, the car GPS knows that there are obstacles in the road, Cheryl, and you don't need to go straight down that road. So it's going to take you around, and it seems like a roundabout, but it's really taking you the safest and the quickest route so that you don't have to stand on that direct road that you thought you could do on your own and waste time waiting there for them to move the accident that's blocking the road or the construction that's keeping the road from going all the way through. So when you try to get out of debt yourself through your New Year's resolution in January, I know for a fact people are going to be calling me by month 2, which is March, January, February, March, month 3, and telling me, Cheryl, I need your help. I need your help. Why? It's too complex to navigate on my own, and I don't have a strategic plan to pay it off. And I'm going to say, don't worry. Fill out the form, fill out the debt analysis sheet, give me that form, and let me show you what the program will do for you. So, guess what? We have the answer. We have the answer for you. Because just like I said, this is a GPS system, and our program is constantly working 24 hours, 7 days a week, strategizing to recalibrate your debt and to come up with a game plan that tells you when things change, how you need to navigate around it to get through it, to get delivered from the debt and the interest rates. Yeah, that's what it does. And what happens is that your income, do you have multiple streams of income? You need to let us know that. Okay. Are you commission based? Are some months better than others? What is the amount owed and term of each debt? What is the interest rate? Remember, I told you about that, including adjusting rates, calculation of the payment, different types of amortization schedules, what's coming months down the road. Okay. So we don't tell you not to spend. In fact, we tell you to spend. Because with this program, when you learn how it works and it's working for you, why wouldn't you spend? Because you're going to pay it off soon. You're not going to be in debt anymore for 30, 40, 50, 60, 80 years. It's one of the things that's so sad to me. When people retire, and they retire because they're sick and they can't work anymore, but not because they can afford it. A lot of people in America can't afford to retire. But because of health reasons, sometimes they can't afford to work as well. So they're forced into an early retirement. But the early retirement may just be their regular age. But financially, the reason why I say early, because financially they just are not ready. But that's not going to be your story. Your story is not going to be that you're not ready, because you're hearing this presentation and you're going to be more prepared because you're going to fill out that debt analysis form. And remember, I don't need your social security number. I don't care what it is. Okay. I don't need your credit card names. I don't care who you owe. What I do care about is that you get out of debt. That's what I want for you. So the quickest mathematical solution, remember, this is not magic, it's just math. One thing about math is that if it's 1 and it's plus and another 1, it's going to be 2. Okay? So the quickest mathematical solution to earn the most amount of interest and pay the least amount of interest. That's what this GPS system will do for you. Okay? Now, the cash flow and strategic debt payoff basically has these are offset accounts, which is a HELOC or LOC. That's line of credit, and a HELOC is a home equity line of credit. That's the difference between the names. And so the checking, there's a minimum reserve, and a OA, which is an open account. HELOC has a critical level. Okay. So there's your income for your checking, and then there's the funds transferred, okay, for the OA HELOC. And then what you notice is that the minimum reserve, when you put it in checking, starts to go up. Okay. And then your funds transfer becomes your optimal transfer point, which is the critical level. And guess what it does? It starts to look at those debts, such as the house, such as the car, such as the motorcycle, and begins to strategically pay it all off. Okay. Promise you, you can't do this on your own. Okay. Now, what do? You end up paying it off, which is a good thing. So here's an example of the monthly expenses for a client. Steve Jones, example client. Okay. So Steve Jones has a $2,398.20 principal and interest mortgage payment. He has $200 for escrow amount, $195 for private mortgage insurance, and he has a total mortgage payment of $2,793.20. Okay, so that's his primary mortgage payment as a monthly expense. Then his other monthly expenses are $3,706.80. So Steve has total living expenses now of $6,500 because you're adding the primary mortgage, you're adding the monthly living expenses. Now we're going to look at Steve some more in terms of his monthly budget. He has $8,000 in income coming into the household. Okay, that's every month. We ask you that because we just need to know what we're trying to figure out with how much, like I mentioned before, discretionary income you have, where when it tells you to put more money toward one of the accounts, that's how it's paid off. But it's not because you pay extra on the 15th. Maybe it tells you to pay extra on the 10th. Okay. And then Steve has $6,500 total living expenses. So when you take the $8,000 minus the $6,500, you're going to come up with $1,500 of discretionary income. Now, here's what the dashboard looks like with the Money Max account. Okay. And it's important to keep some things in mind. First, we have the interest that's remaining on a loan. Okay. So you get to see it right there on your dashboard. You also get to see the number of years to pay off all of that mortgage and loans that are there. And then you get to see the interest that'll be saved as a result of you following the program. Okay. So the interest remaining $144,487 at years, 10.8 months, and then the potential interest. Okay. So now when you think about the HELOC, your first mortgage, $12,875.88. Okay. Now in month one, you've got the offset account, which is the HELOC. And the starting balance was zero because it's a brand new account. But your expenses are $6,500. And so from the HELOC, you can transfer $12,875.88. So now when you put that into the mix, starting balance is zero, your expenses are $6,500, your funds transfers $12,875.88. Your new balance on your HELOC is $19,375.88. And the income is $8,000. So when you take that and subtract, you have an ending balance of $11,375.88. Sound pretty good, doesn't it? So that's $94.80 of interest. That sounds a whole lot different than before, doesn't it? Yeah, I thought you might like that. So what's happened with this situation is you just canceled $58,850.65 in interest. And the estimated left payments are 29 payments. Now, with interest cancellation, you can see here for month one, you've got, again, it's that same mortgage, $398.20 in principal, $2,000 in interest, a remaining balance of $399,601.80, and remaining years, 359. Okay, this is still month one. Then month two, again, you're just adding a little more. That's the traditional way. Okay. So $66,037 principal jump up a little bit. Okay. And we've added $12,875.88 to the principal. Did we do that? Let's see. Well, we've eliminated 29 payments. So it looks like we did. It works. Okay. So now months 2 and 3, you can see how that kind of totals up there. Month 3, you can see how the open account balance starts with that, just a little bit less, but you can see that the ending balance is $8,000. So the interest was only $71.28. Okay. Same thing with month 4. You can see how that starts to calculate as well. And then here's the amortization schedule, which is typical for most mortgages. And we kind of talked about that. Okay. And you can see the principal jumped. Oh my God, $23.89. Okay. All right. So then again, month 7, you can see some changes. And you can see it's just going to pretty much be the same in a sense, not anything drastic. Okay. But if you look at the dashboard for the Money Max account, you can see there's progress being made. Okay. Interest remaining is only $131,866. Years to pay off is only 10 years now, 1 month. And then there's the interest saved. Okay. How do we compare to a conventional plan? $400,000, we start out the same debt, new mortgage, same 400, regardless whether it's conventional or Money Max account. The balance after 7 months with a conventional plan is going to be $397,170. With ours, it'll be $374,223. So you can already see the big jump. Time to pay off is 4.7 years, 56 months under the conventional plan, with just $116.15 difference. And then that's for 30 years. And then with the Money Max account, 10.8 years, and the conventional plan, 463,000 total interest paid. And then you pay a third of the interest with the Money Max account. So choose one. When you look at this, would you rather have 30 years or less than 30 years? Would you rather have 10.8 years? Because I think 10.8 years would be better than paying off 30 years of a mortgage. Okay. 19.2 years is what's saved. Now, this is backed by science. The system with the mathematical engines driven by complex banking algorithms, the first interactive debt elimination program, and it connects to over 13,000 banks and lenders. And there's no magic, it's just math. So achieving your goal, your financial goals begin with debt elimination. You can ask me as your UFF agent to run a free savings report or free debt analysis. Like I mentioned, it'll pretty much look like this. You'll get your own personalized savings report. On the left, it shows you the bank's plan, shows you in the middle the Money Max account pro plan of what can happen. In this instance, you can see you've got the 30 years and 1 month to pay off that loan with the traditional way of the bank. But with us, you got 10.8 years. That's 10 years, 8 months. So let the numbers do the talking. Okay. I mean, you can't let that lie just as a, like, oh my God, I don't know. This is the big picture of your finances. This is the reality of what it is. You may not have a $400,000 mortgage. You may have an $800,000 mortgage, or you may have a $200,000 mortgage, or you may have an $89,000. Doesn't matter. You're paying too much interest if you're doing it the traditional way. But if you come over and talk to me about your free debt analysis, you'll find out you can save today. I want to thank everyone for joining me here today. And remember, you are Victorians. You have the victory. We claim the victory, and we are overcomers. Have a good day.